What's going on, everybody? 360 Digital Closing Bell. Here I am, your humble correspondent, Michael Tanner, joined for you live from an undisclosed location here in Denver. Here on this beautiful Sunday, April the 5th. If you're listening to this, you're definitely going to be hearing this on the morning of the 6th. This should drop at about midnight tonight. As always, I'm joined live from Dallas by my counterpart, executive producer of the show, and the publisher and director of oilandgas360.com, Stu Turley. How you doing, man?
I'm doing fantastic. Hey, thanks for letting me be on your show.
Of course. No, I'm excited. We have a really great show lined up for you again. I know I always say that, but it is true. I'm going to do a quick 5-minute rant on hedging because it's kind of become a big topic this week. We're going to go ahead and check in at the week at oil. OPEC meeting got canceled. Should be a spicy week for oil, especially in the beginning. We'll check in with EFT Twitter. Obviously, we'll check the oil levels, check in with the commitment of traders. We have an interesting swing trade company to watch by our newest anonymous tipster. We'll get into that. We'll give Nick and Steven a call for an iTunes exclusive look at what's going on in the world of midstream. And then Nick is going to talk to us a little more about hedging. I've got a little more in-depth questions I want to ask him, but I want to get that rant done out of the way. But first, as always, we need to get some clerical work done. Please, if you're not subscribed to the show on iTunes, Spotify, YouTube, Twitter, at Entercom, please stop what you're doing, pause this episode, subscribe, rate, review, do whatever makes those algorithms go nuts. We really appreciate your support. I promise you, you send me a picture of you giving us a review, we will send you some merch. We have these t-shirts that say, "Do these rigs make my assets look big?" I promise you. You send me a picture of you giving a 5-star review, I will send you some merch personally. I'll ship it from my house because it's quarantine. I will ship this from my house. We really appreciate all the support. You can also follow everybody on LinkedIn, Stuart Turley, Michael Tanner. You can follow Entercom, Oil and Gas 360. We have a really great set of interviews that just came out. Stu just released one with EnergyNet and Quorum Data, which I don't want to speak too soon, but Stu, those were excellent interviews.
Thank you very much. I had a lot of great feedback on the interviews as well as your news and episodes last week. Great feedback.
Well, good. That's what we want to hear. And there was a previous one with Rare Petro. Please check them all out. You can check them at www.oilandgas360.com on their Energy 360 network. All right, so for just this first segment, before we get into the week of oil and give Nick and Steven a call, I just want to I need to do a little hedging rant. I need to get this off my chest. I've been reading too many articles and I've been seeing too much stuff on both on Twitter and on LinkedIn regarding hedging and how that's playing into what's going on right now. And, so I just want to start by giving a quick overview of, if for those of you listening, if you don't know what hedging is a way for companies who work in industries that their main source of revenue is based upon a commodity. Think about anything. It's not just oil and gas companies. It could be mining companies. There are petroleum refiners. On the East Coast, people get their energy via propane. And so there are companies that do hedging for propane companies that allow propane companies who basically sell energy to these East Coast people to lock in their prices. So it's not just specifically an oil and gas technique, though that's what I think it's become a huge issue within the oil and gas field. And I just want to chat about it. So first off, like I mentioned, hedging allows you to come to a fixed cost on your production, whatever you produce, whatever commodity you produce, allows you to lock in a guaranteed price for that in exchange for giving up exposure to the market, because exposure to the market can either help you or hurt you. The price of your commodity can go up or down, regardless of what's going on. It can always go a little lower. It can probably always go a little higher, especially now that we're dealing with futures. But when we talk about hedging, the idea is, when you look at it, I'm going to lock in a certain amount of my production at a certain price, giving up the ability to make more money, but also guaranteeing that I'm not going to lose money. And so this is exactly akin to insurance. Think about when you buy health insurance. I haven't seen a doctor in a year and a half, but I'm paying for insurance. Why? Because I'm giving up cash now, knowing that sometime in the future, I'm probably going to need to go to the doctor and it's going to be a large expense. So I would rather pay for some insurance over the long term in order to secure myself that I'm not going to go into medical debt if I walk outside tomorrow and get smoked by a car, which is partly why. And it's the same reason. I think of it, when you think of hedging, think of insurance, because what I've been seeing happening in some of these articles, and it's not everybody. There's some really good there's some really good information out there on hedging the right way. But hedging is insurance. And there are too many articles I've seen that have mentioned companies and how to make money off hedging. I'm sorry. If you are going into buying insurance, attempting to make money, I think you're just doing it backwards. In an ideal situation, you should lose money on all of your hedges because that means your price of your commodity is going up. You should, when you enter, how a hedge, how the mechanics of a hedge work for an operator is you agree upon a price with your counterparty, aka me, Sandstone Capital Group, and we say, okay, cool. If it's above this price, we're going to pay you. If it's below this price, you pay me. Now, if you're paying me, that should be a small fraction of what the increase in the commodity price has done for your bottom line. But in an ideal situation, you should be cutting your counterparty a check every single quarter because that's just what it should be, because that means your price of your commodities is going up. Now, that's not always how it happens, and that's why you hedge in order to lock in a specific price. But when I see an article that says, this hedging strategy is going to take this company to the next level, I throw up in my mouth a little bit, because a hedging strategy does not make a company. A hedging strategy can save a company because it can make them less adverse to a huge drop in the price of oil. But a hedge strategy never makes a company. We talk about this in our companies to watch every week. And Stu, I know you know what it is. It's good management makes great companies. It's not a great hedging strategy. Now, a great hedging strategy, like I mentioned, can save a company. It can save a company from disastrous price, and I really want to chat. I want to ask Nick about three-way callers, because that's a disastrous move that won't save a company. But you can save a company slightly via hedging, but good management makes good companies. And so the next article that I see, I'm not going to call these articles out by name because I'm being nice. But if I see another one this week, I promise you, I'll come back next week and we're gonna actually send people. We're gonna push people to the link because I'm getting tired of it. Have you been seeing these, Stews, or just me?
No, it is me too. So comes across the news desk.
I feel you. But yeah, so so to wrap this all up in a ponytail, good management makes good companies. Not necessarily a great hedging strategy, though it can save you. And the mechanics of how you go about a hedge are all dependent on what you're looking for. And hedging is insurance. And if you're looking to make money off buying insurance, I just don't really think it's going to end well for you. So did you like my medical analogy? Was I spot on there?
Absolutely. Very good. How come you haven't gone to the doctor in a year, dude?
I've been for like a yearly checkup, but like I haven't necessarily gotten sick to the point where I've had to cash in my insurance, much as like if the price of oil drops and you have to cash in your hedging insurance. So, I pay for insurance mostly because I run, and you don't know how many times I've almost crossed the road and been smoked by a car. And I don't need to I don't need to go into medical debt the rest of my life because I accidentally jaywalked and got myself smoked by a car. So that's mainly why I have insurance for the catastrophic stuff. And that's how you should look at hedging. So that a catastrophic collapse in the price of oil, and you will not have to bankrupt your company. But if you go into it thinking you're going to make money, or, hey, we're going to design a company around having the most effective hedge strategy, man, you've lost before you even showed up to the game. And I do hedging and advisory around this. Call me up. I charge a lot per hour to just tell you, let's focus on some maybe other parts of your business before we get to a complex. So, but feel free to call me up, 949-561-1818. I'll take your calls all day. Well, that felt good. I needed to get that off my chest. So I needed to get that off my chest.
You don't even have to go run today. Now that you got that off, there's no steam, Michael.
Yeah, I'll still have to get a run in for sure. I've had a decent amount of cup of coffee. But I think we're going to dive into the week of oil trading. And this week, as I just meant, and this segment, as always, is sponsored by Sandstone Capital Group. These guys do insanely great research. All levels, all these levels I'm about to give you is included in their Energy Glimpse solution. Rumor has it they're actually contemplating launching an energy market newsletter here shortly. It's just a rumor, though, so I'll keep you updated on the status of that. If you are interested in chatting with these guys, they're awesome guys. I highly recommend it. You can give Connor McCall an email. It's connor@sandstonecg.com, or give their corporate line a call, and you can just check them out at sandstonecg.com. All right, so this week in oil ahead, I think the biggest thing is, some stories. First off, Friday, obviously, oil runs from $23 to $29 and it ends, 29 even though that futures is probably going to drop to about 28.34 when the market opens. And that's because the OPEC meeting that was scheduled has now been delayed. It has not been canceled, but it's been delayed. And this is when, for the day traders listening, this is why we always talk about buy the rumor, sell the news. Buy the rumor. You should be buying oil on Fridays, and you should be selling the moment the market opens, because that's generally how it works. 99% of the time, the news or the rumor does not add up to what the actual news is. And so, I'm looking for oil based off this to tumble just a little bit this, at least Monday. I mean, obviously I can't predict a Trump tweet. So let's be, who knows what Trump's going to tweet Monday morning, but assuming that account's inactive or he's busy doing some other stuff, my guess is oil falls a little bit. And that's partly because they're talking about, possible OPEC tariffs. And this is the part that now it gets interesting. And this is where, on its face, it sounds good. Hey, let's put an import tax on OPEC oil. And on its face, it sounds good. But if for those of you who aren't, on Twitter, first off, I recommend doing it because I think it's actually, if you use it correctly, it's a great source of real-time news. It's almost the best aggregator of real-time news. And, for the hardcore data scientists out there, Twitter gives away about 7 days. It's like 7 to 10 days of free tweets via an API. And Sandstone Capital Group is pulling that API and doing some stuff with it. And it's not, not that it's easy per se, but it's not as difficult as you would think to go ahead and document these tweets and be able to search via hashtags. And there are certain, hashtags, but and one of them I'd recommend following is EFT, or Energy Finance Twitter. Most people use that to tag, to tag, tweets, and, the people who are more familiar are like, all right, get on with it. Give it a hashtag is. So, all right, you guys give it a hashtag is. That is the one to use. And Dan Pickering, he's the CEO or founder and CIO, of Pickering Energy Partners, which is another really good energy research consulting firm. He tweeted out 3 really good things last night that I think kind of put into perspective this oil tariff idea that was going to be pushed around from President Trump. And one was, all right, EFT needs some help. I'm trying to think through how a potential U.S. oil tariff would play out. Trump tariffs Saudi, Russia, OPEC oil. Then what? Refiners must scramble for other crude grades. Big game of duck, duck, goose with crude barrels. Has anything changed? Next tweet. So do they make WI Brent spread do some funky moves? Probably chaos for refiners. Would they be imposed along with some import restrictions? U.S. storage feels faster or slower? Trying to think through the permutations. Appreciate the help. And then this is the next tweet he does, which I think is the moneymaker right here. If imposed, assume OPEC Russia crude coming in gets taxed, raising price. But buyers don't just import. But don't buyers just import cheaper barrels from somewhere else? Ding, ding, ding. Does U.S. crude producers really benefit? If U.S. refiners have to buy only U.S. Canadian crude, where do the rest of the barrels come from? Ding, ding, ding. It's that last sentence. If U.S. refiners have to only buy U.S. Canada crude, where do the rest of the barrels come from? Because, and this is something, and I'm going to bring Stu in because there's actually a really great tie into an interview we did. But first, I will link to the EIA production numbers for this week in petroleum. U.S. crude production as of 3/27/2020, 4-week average, 13 million barrels a day. Crude imports, 6.2 million barrels per day. What's consumption? I should pull up the EIA. I don't have the EIA numbers up right now, but consumption has got to be in the 20s. I think 20 is about what it is. Pickering, Dan's right. Where are the barrels coming from, Stu?
Yeah, no idea. Well, the barrels are coming in also from Russia, big time. Mm-hmm. And so when you start looking at how they're being pulled in, I just recently had the Quorum interview with Olivier, and he is with Quorum Software. We talked about an interesting solution that fits right on into Dan Pickering, and kind of a almost half joking way, I think that he had a great idea. Instead of looking at just Canada for the heavy, bring in Mexico, We've already got trade agreements with both North and Canada and Mexico. But if we formed the North American exporting countries, Olivier came up with NAPEC, North American Petroleum Export Countries. That would really help put the pressure on Russia, because now Russia has really crappy oil. We are the only ones that can refine the Russia oil. Do you know the kind of hurt that would put on them? Right now, Novatec is up $34 in pre-market, and they're a $987 stock. They're the largest LNG producer in Russia. Big issue.
Yeah, no, that's some great numbers, and I tend to agree with you and Dan Pickering on this issue. I don't know if this will work. You either have to do a flat, import tax on any oil that comes in. Just doing OPEC or Saudi and Russian oil does not solve the issue. But this NAPEC idea, we need to get like hats. We need to get some merch with NAPEC written up. Let's get some T-shirts that say NAPEC and start selling them. No, I'm dead serious. If you want one, email me, mtanner@entercominc.com. We'll get some NAPEC shirts fired up.
Oh, you got to give hats off to Olivier.
Sponsored by Quorum Data. We'll get their logo on there for sure.
Oh, absolutely.
Yeah. We're going to get these distributed. So if you want one, please email me, mtanner@entercominc.com. We will get these shirts made.
And Dan Genovese was also on that interview as well too.
Okay. Well, good.
Yep. All right,
everybody. So, that's kind of the stories. If where do the barrels go if this import tax or if this Saudi Russia thing does happen? And this OPEC meeting get pushed, I think crude's going to be depressed, and that's why when we get into the levels for the week, 29 was what the market closed at. I don't see it I don't see it going higher Monday at least. I definitely think depending on some of the news that drops this week, it could get up there. But really, I see support-wise, 28 is the first level. That's kind of where the first crest happened when you talk about for that that second spike on some of that news that hit Friday. The next level of support purely based on volume, 26.69. That's sort of that next level in terms of a volume chunk down on the downside. In terms of a floor, depending on what the news comes out, I mean, we could be all the way back down to 23.55, which was that top we had before the beginning of the week. I'm not saying we're going to be down $5 next week, but you never know. This is we're talking about futures contracts here, so this is a rumor-driven business. So really, just it depends on what happens. If OPEC does what they continue to think we're going to do, and even if they delay, but they come to some sort of production agreement, that's going to help. Now, the other thing that we've stopped talking about because I feel like we're just beating a dead horse is this virus. That's still impacting the demand for oil by 20 million barrels. So baked into this equation always is that the coronavirus outlook. So, yes, we could, if we cut 4 million barrels a day, that's great. That's probably going to get oil to $35. But, this virus is really, it's especially, on top of just the devastating effects it's had on the economy and what it's going to be like if we have to shut down. I mean, I think everywhere is pretty much self-quarantined till end of April, right?
Yep. But also you've got the glut sitting on the ocean. Yep. You're not going to just turn that spigot right on as far as being able to have a reduction in production because you still got to go through everything sitting on the ocean first.
Well, and I think this is the other thing that people don't realize is we haven't built any new refineries. Our refining capacity is the exact same as it was before this started. And now we have how many barrels sitting on? Oh man, these refineries, I mean, they're actually going to be making out well, especially if they can purchase this crude cheap. If they can figure out a way to store it themselves, and that's where these refiners are looking into. But yes, no refineries. We've made zero new refineries, so it's going to be a long time before I think we see this demand and supply balance out. But hey, we'll take OPEC and let's get some NAPEC in there. I like it. I love it. No, I really like it. On the upside for oil, if you're an insane bull, which we love bulls on the show. Really, next big volume chunk, $34. Anything higher than that's just sort of a speculation on that point. Really, because, really 35 was the gap down from 47 from 42 when the market, when we heard the OPEC news, it went from 42 down to, 27. So anything above 34, which was the top of this 2 weeks ever since March and this OPEC stuff, anything above there's a guess. I mean, if you're looking at a 3-month chart right now, there is zero volume between 36 and 41. So, I mean, there's your tops. I'm not gonna sit there and predict from a day trading level where I think it's gonna go. Perma bulls, 32 to 34. That's probably your target zone. But I don't expect that to happen Monday, so I would be selling Monday. And again, we don't give investment advice, but if you're trading, and specifically if you look at order flow, I would be selling Monday at the open. Check in with our commitment of traders. Just to remember, our commitment of traders this week runs the Friday. This is the 27th through the 3rd. Or excuse me, no, my bad. This is the 23rd through the 30th. So we're about a week delayed. But if you think about that time frame, that just gives you an idea of what the time frame looks like. Producers, merchants, and producers. So these are companies hedging. Added 51,000 contracts to the long, but they shorted about 74,000 contracts. So very odd to see both long and short contracts up, and that brings your producers and merchants to about a 50-50 balance between their long and shorts, about 540,000 contracts on the long side to about 562 on the short side. When we look at hedge funds, they're adding to their oil positions. I mean, they've been long on oil for over a year now, waiting for this thing to get up back to 100. But we're starting to see that spread between long and short come in. About 23,000 contracts. 23,000 contracts added on the long side to about 22,000 on the short side. And we're looking at about 266,000 on the long side to 100,000 on the short side to give you that breakdown. Swaps became really, swaps. A lot more swaps are happening right now. Usually the swap short side is much, much, much heavier than the long side, and you generally see more short swaps get added than longs. But today was one of the first weeks, I think last week as well. You can actually go check this all out at cotlegacy.com. They make this. It's the chart I pulled, some open source software, so you can shout out to those guys. I'm pretty sure last week or 2 weeks ago was the first week we had the swap dealers come out and be more on the long side than the short side, and that's just obviously because of this collapse in price. So it'll be interesting to see how long that takes place. And this is going to roll into our segment 3 and or our company to watch by our newest, and we really appreciate all of our anonymous tipsters. But this guy's been giving us great tips for multiple weeks. He's a big fan of the show, and so we gave him a call sign Tomcat, and he reached out to Stu and gave us more a company to watch on the swing trade side, and I'm all for it. So this week's company to watch is just more of a swing trade. But Stu, I'll give it over. What's Tomcat got for us?
Tomcat. That's his call sign out of the military. So hats off to all of our military folks. We absolutely love them. He's first time in 28 days, the charts are showing a buy sign on FANG, one of your favorite there for Diamondback. So Diamondback is absolutely looking kind of about ready to start rolling there. The other one was Magellan Midstream. The fundamentals are looking really, really good. It's got a 4.57 on a 1 to 5. 30 days ago, it was a 4. Their EBITDA is 3.48, and the RSI is 43.44. Not bad on those two right there.
Yeah, and Steven, not to cheat, we'll call Steven here at the end, but he sent me a nice little overview document on Friday of some things to watch. Magellan Midstream Partners, their CEO came out and said that this contango environment is going to be an expected uplift about 7 to 10 million on their bottom line. So, I mean, definitely reflected in those numbers and the fundamentals. And, I love Diamondback. First off, the account is, this is a $100 stock that is low because of oil. So if you're, this company's not going anywhere, and it's, trading now at 31.52 or 59, was the market close. when you look at the technicals, Tomcat is right. The moving averages have flipped. It flipped early Thursday. Moving averages from 5 all the way to 20 give us buys. When you get into the 30 through the 200s, they'll give you sells, but we're not institutional traders. So to give you an idea, if you want to know how most hedge funds operate, they take a look at a chart, they throw a 25 or a 50-day moving average, and they throw on a 200-day moving average. And when those intersect each other, as in the 200-day moving average intersects with the 25, they purchase. And when they recross, they buy and sell. And you can look at a chart, and if I really highly recommend going on an S&P 500 chart, doing about a 4-year, do a 5-year time frame, and throw on a 200 and a 50-day moving average, and you can really mark out buy symbols. And so anything above 20 to 30-day moving averages is you're looking at an institutional long-term trade. So I love the fact that Tomcat's coming in and talking about our smaller range and our moving average, because that's what affects guys like us who day trade. On the Magellan midstream side, we're definitely going to have to talk to Steven about that, because I know he's going to have some thoughts on that. But I do love the EBITDA being 3.48, RSI being 43. That's, in this environment, that's strong. And there were people probably buying, there were probably people a little earlier on that than we are. So it'll definitely be something to watch there. Diamondback Resources, if I had to give a if I had to give a one way or the other, yeah, it'll be very interesting. I'm going to go ahead and agree with Tomcat on this one. I think we'll put this, because this is, because agree with me. So this is one of the 10 companies that is going to have a decent balance sheet when we come out of this.
Yeah, you bet. It's kind of also nice that Tomcat is given a reference also with our next guest. So, having validation from 2 different sources, not bad.
No, exactly. And so, that's why if you're looking at a swing trade, now a swing trade's not a day trade. This is let's see what happens this week. And to be honest with you, I wouldn't put a limit order in for the market open. If you're interested in taking some action on Diamondback, again, we don't give investment advice on this podcast, but I would highly recommend waiting to see what happens Monday, because I definitely could see a depression Monday and Tuesday in the price of oil. So just some tips, but again, we don't give investment advice. So, but yes, I think it's time to get. I think what we need to do is that's everything on my technical side for Diamondback. So please, if you guys have any stock recommendations or you have any charts that you want us to look at, please, you can email us, mtanner@enercominc.com, sturley@enercominc.com. You can find us on LinkedIn. And first thing we do, I think we need to go on and get Nick on the phone and chat with him about hedging, because I know he's got some stuff for us. All right, really great stuff from both Nick and Steven. And with that, we're going to go ahead and let you guys get back to work. Thank you for checking out episode 5 here on the 360 Digital Closing Bell. We will see you guys this afternoon for the Digital Ticker.